Welcome to the Stock Market Palantir. Today we are going to talk about AIIO. Welcome to the debate. Today we are analyzing a stock that really just embodies the high-stakes friction within the current small-cap market, Robo.ai Inc., trading as AIIO. Now, this company, formerly an electric vehicle manufacturer known as NWTN, is navigating an extremely complex path. It's defined by severe financial distress, a really traumatic corporate rebrand, and a market narrative focused purely on that high-risk, high-reward potential.
And that intersection it's critical. I mean, AIIO has pivoted from the capital-intensive world of EVs to this AI-driven robotics platform. And that's coupled with some, let's say, highly conditional commercial announcements. It really presents a perfect storm where the aspirations of a modern tech narrative are running headlong into the harsh realities of a deeply distressed balance sheet.
And that collision right there defines our central question for today. Does Robo.ai's strategic pivot and its, substantial recently announced procurement agreement represent a legitimate high asymmetry recovery play? Is it anchored by market narrative and potential technical squeeze mechanics? I mean, is there a path to value unlock here?
Or conversely, and this is my side of it, is this fundamentally just an unsustainable corporate maneuver, one that's destined for delisting and frankly catastrophic dilution, considering the severe and, let's be honest, undeniable financial distress that defines their operations? I'll be arguing that the overwhelming execution risks and the critical lack of liquidity just make the whole recovery narrative implausible.
And I'll be arguing that while the risk is enormous, you can't deny that, the magnitude of the reward driven by the AI pivot and that big W Motors contract justifies analyzing this as a compelling high asymmetry trading opportunity. We have to look beyond the immediate balance sheet and focus on the technical and liquidity dynamics that could fuel a major reversal.
Well, let's start with the hard numbers then, because, they provide the structural foundation for my skepticism.
I see why you think that, but let me give you a different perspective. This isn't an investment in traditional fundamentals right now. It's a high asymmetry trade on execution and liquidity dynamics. The shift to the AIIO ticker and the integration of AI, robotics, and newer concepts like Web3 and DeepIn, that's not accidental. It's an astute maneuver designed to discard that low multiple EV label and tap into valuation multiples that are, exponentially higher, purely based on investor attention.
That sounds a lot more like financial wizardry than it does sound business execution.
It's a necessary survival tactic. And crucially, the announcement regarding the W Motors agreement is the catalyst that validates this whole shift. A commitment to procure no fewer than 30,000 vehicles over 5 years it's massive. That kind of volume, even if it's contingent, represents potentially hundreds of millions in future revenue against a current market cap of less than $200 million. It's a huge discrepancy that fuels the bull case.
A discrepancy based entirely on a projected, non-guaranteed future. I'm sorry, but I just don't buy that narrative. Let me tell you why. The structural reality facing investors is defined by a horrific operational picture. The fundamentals are catastrophic. You just can't ignore them. The company generated only $5.74 million in trailing 12-month revenue against a staggering net loss of negative $142.6 million.
Sure, but that inefficiency is already priced in, perhaps even to an extreme degree.
But do we appreciate the scale of that inefficiency? They spend nearly $25 in operating costs for every single dollar of revenue they generate. Their quick ratio sits at about 0.3. And for listeners who aren't familiar with that metric, that means for every dollar of current liabilities they have, every bill that's due soon, they only have 30 cents in liquid assets, like cash, to cover it. That's a near insolvency signal.
But that signal is precisely what creates the technical environment for volatility. From a market microstructure perspective, this stock it's primed. The Fintel short squeeze score has been extremely high, sitting in the mid-90s. And that metric is driven by a critical scarcity of shares available to borrow. We're talking as low as 10,000 shares sometimes, combined with a restricted effective float.
Well, that scarcity exists because the stock is distressed, which makes it incredibly risky to hold in the first place.
True, but when the borrow rate is astronomical because of that scarcity, even minor buying pressure can trigger these disproportionate spikes, forcing technical short covering. This is the mechanism that creates the high asymmetry trade.
You're focusing on the volatility. I'm focusing on the necessary capitulation. The liquidity situation is alarming. Our estimate is a fixed monthly cash burn of about $12 million. With cash reserves potentially under $2 million, the implied cash runway is critically short. We're measuring it in days or weeks, not months. The company faces immediate, massive capital raising just to keep the lights on, regardless of any future contracts.
But the W Motors deal is designed precisely to address that need, to frame it as an R&D financing play.
And that brings us to the critical structural flaw of that WM Motors deal. It is entirely conditional. It is explicitly dependent on the successful development and testing of the vehicles, with a start of production targeted for 2026. This isn't revenue. This transforms that massive order into an unfunded, capital-intensive R&D liability that the company, by any figure, simply cannot afford to begin funding.
Okay, this brings us directly to the core of the debate then. The legitimacy of the W Motors contract as a financial instrument versus, just an aspirational goal.
It is aspirational because the financial hurdle is insurmountable on their current balance sheet. So let's be clear, we have $2 million in cash and a requirement to execute R&D for 30,000 complex next-gen vehicles. How can a company with sub-$2 million fund the R&D, the prototyping, the validation, and the manufacturing tooling required for that?
That's a fair characterization of the immediate financial strain, I'll give you that. But the contract serves as crucial collateral. It functions as a powerful proof of concept for securing that next round of external financing. And yes, that financing will be dilutive, likely massively so. But it is the only path to survival. The market is pricing in the contingency, sure, but the sheer size of the order validates the strategic pivot to potential investors. The success of the Astra subsidiary's proof of concept is the binary trigger. If they secure initial funding based on this contract, the trade succeeds.
But how structurally sound is it to use a conditional 2026 contract as collateral for 2024 cash needs? The execution risk is compounded because they aren't just building cars, they are integrating these unproven, technically complex elements like RCREAN and DPIN.
Right, DPIN, decentralized physical infrastructure networks, is cutting edge. It involves using tokens and Web3 structures to, incentivize the sharing of physical infrastructure, likely data from the vehicle sensors.
Exactly. So they are trying to bolt a futuristic, crypto-based network onto an EV platform built by a company with days of cash runway left. It just screams desperation. It's like they're trying to aggregate all the high multiple themes at once.
Maybe, but the contract is the only leverage they have.
Okay, so if we acknowledge that external financing is necessary, then we have to look at the corporate authorizations. Shareholders have already approved a massive increase in authorized share capital, creating billions of new Class B ordinary shares. This authorization, it isn't a theoretical backstop. It signals the overwhelming probability of immediate massive dilution needed just to raise that $12 million monthly cash burn. That structural selling pressure is going to suppress the stock price regardless of the contract's successful execution 2 years from now. The capital injection they need just crushes the existing equity value.
That financial reality, though, pushes us directly into market microstructure. Because structural suppression can be temporarily and violently overridden by technical dynamics. Let's go back to the mechanics of the short squeeze. The scarcity of borrowable shares and that high Fintel score create a powder keg.
I understand the retail narrative, the YOLO faction, as you might put it, drives those short-term spikes. But we have to differentiate between that sentiment and what the institutions are doing. When we look at the trading data, we frequently see the off-exchange short volume ratio exceeding 50%, sometimes hitting 58%. This points to massive dark pool activity.
Which you might argue suggests short manipulation.
I would frame this high dark pool activity differently, as sophisticated institutional hedging. Market makers are shorting heavily off-exchange to remain delta neutral against retail buying of options, especially calls. To be delta neutral just means they're ensuring they won't lose money if the stock moves dramatically up or down. They are essentially selling insurance to retail buyers.
That's a compelling point, but I would frame it differently. That hedging activity doesn't eliminate the short squeeze potential. It actually highlights the system's volatility and fragility. The low float, the actual number of shares available to trade, is restricted due to significant insider and original SPAC ownership. So even if the dark pool activity is sophisticated hedging, the high cost to borrow due to that scarcity forces liquidity-driven short covering.
And that liquidity-driven covering only provides temporary, massive volatility, the pop and drop you described earlier. It's a mechanism to trade, sure, but it's not a mechanism for sustainable value creation, which is the whole point of a recovery play.
For the short-term trader, the volatility is the value creation. The high cost to borrow acts as a constant pressure release valve.
UTN to Robo.ai is really supported by any substantive technological capabilities, or if it is largely a marketing maneuver to just, aggregate multiple high-interest investment themes, AI, EVs, and crypto, into a single equity story. Where is the R&D proof that justifies the Robo.ai name?
The market rewards narrative. The company's responding rationally to investor sentiment that has, decisively cooled on pure-play EV manufacturers. Look at the empirical correlation. The presence of AI keywords demonstrably increases retail attention and fuels temporary price appreciation.
But is that sustainable? They're rebranding into AI while facing a severe solvency crisis. It just feels like desperation.
For a company facing an imminent solvency crisis, desperation is the mother of invention. Leveraging the AI narrative is their core survival strategy. They're explicitly seeking the higher valuation multiples required for that absolutely crucial capital raise. They may not have the tech fully developed, but by announcing subsidiaries like Astra and linking themselves to DeepIn, they signal intent. In this microcap environment, the market often grants them credit for that intent and the license to operate in that coveted space.
But that intention creates confusion too. We still have significant retail investor confusion with the separate entity, Newton Golf, which trades as NWTG. That confusion is indicative of the chaos inherent in this environment. If sophisticated investors are shorting this heavily to hedge, they clearly don't trust the stability of the entity, regardless of its narrative appeal.
The institutional hedging indicates they're prepared for the downside, yes, but the restricted float and high borrow cost mean they are also exquisitely sensitive to upward shocks. That's the tension. It's an arbitrage between financial necessity and market optimism. And ultimately, the narrative pivot is a clever attempt to raise capital, but it doesn't solve the immediate liquidity crisis or the existential NASDAQ delisting threat hanging over their heads. So the investment thesis here is binary. It's high risk. I maintain that the company has skillfully set the stage for a major rally through the W Motors catalyst and the higher multiple AI branding. If, and it's a big if, they successfully secure the necessary financing based on that collateral and manage to stave off NASDAQ compliance issues, the upside potential is massive, and that justifies the significant risk inherent in trading this distressed, volatile instrument.
And I maintain that the overwhelming weight of the financial reality simply overrides the narrative. The extreme negative net profit margin and the cash runway measured in days, it fundamentally overrides the aspirations of a 2026 contract. The structural issues, the NASDAQ threats, and the necessary, inevitable dilution from the authorized share increase, it all means that sophisticated capital views this entity as positioned for capitulation. The dark pool shorting is the evidence. Institutional money is heavily insuring against the exact aspirational outcome you're hoping for.
So for investors looking at AIIO, they are not assessing a stable, predictable business.
No, not at all. They are assessing the timing of solvency and the success of a complex, high-stakes arbitrage between a crippling financial reality and a desperate, but I admit, compelling market narrative. That tension defines everything about the stock right now.
That is a sharp summary of the conflicting forces at play here, and it's why this is such a fascinating, high-stakes analysis. The question remains, which force prevails first? The need for capital or the market's willingness to supply it based on the story?
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights And see you in the next video.